You're probably aware that the interest rates are rising. That is unquestionably true if you're looking to borrow money. However, if you're putting your money into a local bank, you're not likely to see an increase in your return. Regrettably, most banks continue to pay interest on savings that is only a fraction of a percent. So perhaps it's time to fire your bank and look for a new place to put your money. Here are 7 options better than your bank that will make more money. Number 1, peer-to-peer P2P lending. This is one of a kind approach to investing in fixed income assets. P2P lending formats allow you to invest in borrowers' loans. The primary goal of peer-to-peer lending is to remove the banker from the loan agreement. Instead, you, as the investor, take on the role of the banker. Your money is being invested in loans made to individual borrowers. That's not nearly as dangerous as it sounds. You do not actually fund the borrower's entire loan. Instead, invest in what are known as notes. These are loan units of $25. A person borrowing $25,000 from a P2P platform may have his loan funded by up to 1,000 investors, each paying $25. This reduces any investor's risk in a single loan. It also allows you to diversify across a wide range of loans. With a $1,000 investment, you can spread your money across 40 different notes. Furthermore, you have control over how much risk you take on. You can invest more aggressively by purchasing higher risk, higher yield loans, or you can invest more conservatively by purchasing lower risk, lower yield loans. Number 2, blended portfolio. This is a more creative approach to increasing the returns on your savings. You can build a portfolio that is a mix of equities and bonds, but the emphasis should be on bonds. The goal is to take advantage of the relative safety of bonds, while also incorporating the greater yields provided by stocks. For example, you may build a portfolio that is 80% bonds and 20% stock. If you want to be a little more aggressive, you may be investing in 75% bonds and 25% stocks. This portfolio is a risk that is CDs or treasury securities, but is a potential to provide larger returns. You will not only receive interest income on your bond part, but you will also receive the benefit from capital appreciation on the stock option. It will increase your overall return by at least a little bit, above what you would obtain from interest-only investments. This is not a difficult technique. There are automatic investment programs known as robo-advisors that can design such a portfolio for you. Betterment and Wealthfront are 2 popular robo-advisors. They will construct and maintain your portfolio for a very minimal annual cost, 0.25% of your portfolio. Robo-advisors typically examine your investor profile based on your investing objectives, time horizon, and risk tolerance. By selecting a short time horizon, you can set a very high bond allocation. For example, if your time horizon is 3 years, your portfolio will be primarily invested in bonds. It is possible that you will lose money with this portfolio mix. However, it will not be as nearly as volatile as a portfolio primarily comprised of stocks. Once again, it's preferred for long-term savings rather than an emergency fund. On downside of P2P investing is the lack of liquidity. Once you purchase a note, you are committed to that investment until it pays off. This is often between 3 to 5 years. However, if you mix your maturities, you'll always have some notes coming due. Number 3, real estate investment trust. If you want to avoid stocks and bonds, you can invest in real estate. This is possible in real estate investments trusts or REITs. REITs are real estate investment trusts. They're similar for mutual funds for real estate. The primary investment in commercial real estate, such as office buildings, retail space, and huge apartment complexes. Some, on the other hand, work on smaller projects, such as home renovations. Others watch significant industry indices. An ETF is the simplest way to diversify across multiple REITs. The iShares Core US REITs ETF, for example, has a current distribution yield of 10.64% and invests in over 160 distinct REITs. An ETF is the simplest way to diversify across multiple REITs. The iShares Core US REITs ETF, for example, has a current distribution yield of 10.64% and invests in over 160 distinct REITs. Another way to invest in real estate is through internet crowdfunding platforms. This is where you can put your money to work in the form of loans and equity positions in specific real estate transactions. Real estate investing in any form is not very liquid, so it's a type of technique you'll want to utilize for money you won't need for at least 2 or 3 years. Number 4, high dividend stocks. We're about to dive into a risky manner of investing your money for bigger yields. Large dividend stocks might lose value even if you provide high yields. You should not invest your emergency fund money in these stocks. However, you might invest a portion of your savings in them to boost your overall savings yield. Number 5, bonds. Bonds are long-term investments that yield higher interest rates than savings accounts, but also crucial to remember that bonds aren't fully risk-free. They, like equities, can fluctuate in value. As a result, if you're going to invest in bonds, you should avoid particular issues. The preferred option is to invest in bond funds via exchange trade funds, ETFs. linked to indexes. You'll receive a professional managed bond portfolio, which considerably reduces the dangers of any single bond issuance defaulting. I prefer to invest in two types of bond funds: high yield bonds and municipal bonds. Corporate bond yields have been low in recent years. High bond yield funds, on the other hand, maintain portfolios of issues that offer higher yields due to the issuing company being deemed more risky. They can, however, generate large profits on short-term investments. States and municipalities issue municipal bonds. They pay lesser interest rates than yield bonds, but the interest is tax-free in the United States. Furthermore, if you live in the states where the bonds are issued, the interest will be exempt from state income tax. Number 6, U.S. Treasury securities. Not only do these assets yield much higher interest rates than local banks, but they are also regarded as the safest investments on the planet. U.S. Treasury securities are debt issued by the U.S. government that is fully guaranteed in terms of both principal and interest. There are various types of U.S. Treasury securities, which are determined primarily by the term of the instrument. Treasury notes, for example, have maturities ranging from 2 to 10 years, but Treasury bonds have maturities ranging from 20 to 30 years. However, you will be primarily interested in Treasury banknotes. These are short-term investments with maturities range from 1 month to 1 year. They are not as liquid as savings or money market accounts at your local bank, but they are relatively short-term and pay far more in return. You can also sell them before their maturity dates if necessary. Number 7, online savings. No one would have considered this possibility a few years ago. Online banking would have been deemed too dangerous. In addition, most banks now provide internet banking. So what distinguishes online banks? They don't have branches all over the country, nor do they have the overhead expenditures and payrolls like brick and mortar banks do. Banks may pay substantially greater interest rates on deposits because they have reduced operating overhead, and now that they've been around for a few years, online banks are gaining widespread acceptance. Why should you keep your money in a web-based bank? Because the banks are not simply greater than those local banks, but they are significantly higher. And despite the fact that online banks are totally based on the internet, they are absolutely liquid. You can transfer dollars in and out of them, as well as form other banks, and you can even access your accounts at a network ATM. Perform a background check on any online bank before you think about using. Find out how long the bank has been in business and whether it has the FDIC insured. You can keep your local bank for checking and loans, but you'll earn much more money if you move at least the majority of your savings to an online bank. And if you want to lock up your money for a little longer in order to earn more interest, look into rates offered by online banks on certifications of deposits, CDs. They are also far greater than rates offered by your local bank. So what do you think about these 7 options? Better than your bank that will make more money. You can pick as many or as few of these options as you like. I just want to point out that there are several ways to invest and get interest. Whichever of the following choices appeals to you most. Are you already utilizing one or more of these alternatives? Let us know in the comment section below. Thanks for watching. See you in the next video.